Hi, welcome back. My years of teaching and writing, I've tried as hard as I can to keep politics out of my teaching and out of my writing. And that's deliberate. I teach corporate finance and valuation, not political science, and it's not my role. It would be unfair of me to impose my political thoughts on you. On Tuesday, November 8th, though, there was a big political event. The event, of course, was the election of Donald Trump as President of the United States. I have no intent to revisit the entire election and play out all of the debates, but I want to talk about the investment and financial implications of what happened on November 8th. And as I sat down to write about what I thought the implications were, I noticed that I was writing much of the same stuff that I wrote in June when UK voters chose to exit the EU in Brexit. Now, let's face it, both events, pollsters did not see it coming, political experts did not see it coming, journalists did not see it coming, markets did not see it coming. So when it did happen, it was a surprise. And on November 8th, that surprise hit markets initially in dire ways. Dow futures plunged almost 800 points, the Mexican peso lost ground, gold jumped in price, the T-bond rate dropped. In fact, all of the stuff you would expect to see in a crisis. And I decided that there was no way I could avoid talking about it or thinking through how this would affect the valuations of companies and my investment philosophy. So, what I decided to do was take a look the day after. And the day after actually dawned much more favorably than it looked right at the time of the election. In the 2 days after the election, in fact, here's what I saw happening. So I looked across markets and I first looked at the US Treasury market. And across the board, treasuries, the rates on treasuries increased. The 3 month rate, the 1 year rate, the 5 year rate, the 10 year rate. In fact, the 10 year rate was up about 0.27%, a substantial jump in that rate. The 3 month rate was up about 0.04%. In other words, not only did interest rates go up, but the term structure became more upward sloping. So that was the first impact, a fairly substantial one. Then I looked at the US dollar. It's fairly mixed against most of the currencies. It strengthened slightly against the euro, dropped a little against the pound, strengthened against the euro. It was the Mexican peso where you saw the biggest jump in the dollar or the drop in the peso. Then I looked at US stocks. The Dow was actually up almost 2.6% in the 2 days after the election. The S&P 500 was up 1.38%, not bad for 2 days. Small cap stocks were up 3.5 times more than the S&P 500, but the Nasdaq was surprisingly flat. We'll come back and talk about what might have caused that in a minute, but clearly stocks were not, if you look across stocks, they had a pretty good 2 days. And if you looked at stocks in other markets, European stocks were relatively unaffected by what happened. The Bovespa was down and the Mexican Bolsa was down. So if nothing else, Latin America seemed to feel the impact a lot more negatively than the US did. And in Asia, the effect was fairly neutral. The Nikkei was up about 1%. The Hang Seng was down a little bit. The Sensex was down a little bit, but not much. The fear indices, and these are the indices which capture when a crisis is kicking into full flow. Gold prices actually dropped in the 2 days after the election. Silver prices were, increased just a little bit. The VIX, which is a measure of volatility in the stock market, expected volatility, dropped dramatically. It went from 18.74 at close of trading on November 8th, that was before the election results were known, down to 14.74 on November 10th. What does this all tell us? I mean, if you look at the big picture, it seems to be that this event, while it was presented as a potential crisis at the time that happened, didn't play out that way, at least in the first 2 days after the election. Of course, it's still early, but taking a look across sectors, there are some interesting shifts you saw in those 2 days. The sectors that did the best over the 2 days were financials, financial services, and so banks, insurance companies, healthcare, and industrials. Materials did relatively well as well. So those were all sectors where in the 2 days after, 2 to 3 days after the election, you saw a big jump in prices. Now we'll come back and talk about what might have caused them to increase. But with healthcare, the most immediate thing you can point your finger to is the fact that Donald Trump has promised, or at least pledged, to repeal Obamacare. And that's going to have consequences, different consequences for different pieces of the healthcare business. But at least in the initial 2 days, the market reaction was, hey, pharmaceutical companies are going to be worth a lot more. Now, some of this might be coming from Trump's promise to repeal Obamacare. Some of this might just be relief that Hillary Clinton was not the president because she had promised to crack down on pharmaceutical companies' pricing and also to constrain and restrict banks more than they are right now. So when you saw the positive price impact, it might have been more to do with who was not president than who was president. Now, if you look at the sectors that did the worst, the utilities were the worst performing sector, and the reason for that is relatively simple. Interest rates go up. Utilities that are high dividend paying stocks tend to act a lot like bonds. They were impacted. Consumer staples were down. Real estate was actually pretty flat. Now, ironic given that Donald Trump is from real estate. And finally, technology was up about 1.4%, much less than the rest of the market. In fact, it looked collectively like technology was the underperformer. And it'll be interesting to keep tracking this because if you read the tea leaves here, you can see why the stocks that did well, and the stocks that did badly, and you get to technology and say, what's going on here? Well, some of this might be reflecting fears that immigration controls could hit technology, particularly because they're so dependent on granting visas to the people who write their software and make the technology run. So maybe that's it, or maybe that they will no longer be as favored as they've been for the last 4 years under the Obama administration. So who knows? It's a little too early to build elaborate stories, but interestingly, in the 2 days after the election, markets don't seem to have freaked out. So the pricing effect has been not just muted, but relatively positive post-election. So I stepped back and started asking a different question. How does the election of Donald Trump as president affect the value of stocks? And I divided up the discussion into two parts. One is the effects of what I see as his potential policy changes that are coming on the overall value of all stocks, and also the effect of policy changes on individual sectors and how they might be impacted. So let's start with the overall stock effect. When I think about value, I go back to basics. The value of a stock, the value of a business is a function of its cash flows, the value of its growth, the risk-free rate, and the risk premium. We take each piece and talk a little bit about how Trump policies, at least the ones that he's put down on paper and he says he's going to push through, might affect each of them. Let's start with the risk-free rate. Donald Trump was not very kind to the Fed during his run-up to the election, and while I share some of his sentiments, he seemed to feel that the Fed had played a political game with interest rates, and perhaps it has, and that it should stop playing those games. I don't know how this will play out at the next Federal Open Market Committee meeting, which should be relatively soon. And they have telegraphed that they're going to raise rates, but it'll be interesting to see how the election results might affect that decision. There's a much more fundamental impact on interest rates that you could potentially have from the Trump policies, the ones that he says he's going to do. He's talked about increasing investment in infrastructure and cutting taxes. Now, if you carry that through and you think about the positives, maybe it'll push up growth, or the negatives, it could push up inflation. The effect is going to show up in the risk-free rate. So the near-term effect on interest rates, I'm not surprised to see interest rates go up. It'll be interesting to keep watching interest rates to see if they keep going up to 3 or 4%, which would suggest either much higher inflation or much higher real growth than the status quo. Let's turn to the risk premium. The story here is a much more muddled one. On the one of the concerns that people have about a President Trump is that he's unpredictable in good ways and unpredictable in bad ways. And unpredictable leads to much more uncertainty about the future. So if you had a convoluted story to tell, you could say, well, Trump's unpredictability will translate into a much higher risk premium, both for stocks and bonds, which will push down the price of stocks and bonds. Trump has also been pretty open about contending that there's a bubble in financial asset markets. I don't agree with him on that one, but to the extent that he has a megaphone and he can get people to believe there's a bubble, that could affect risk premiums as well. But the stories you tell about risk-free rates and risk premiums, at least for risk premiums, seem to be stretch ones. I don't see a direct effect on risk premiums in the near term. In the long term, we'll have to wait and see. The one big box which can affect the values of all stocks, where Trump can have a significant negative impact, is on his trade policies. He's talked about not just not signing new trade agreements, but maybe revisiting old ones like NAFTA and potentially putting in, tariffs or barriers to trade against countries that he feels have taken advantage of the U.S. China and Mexico being the lead, two countries. Now, the perils of starting a trade war is the other side reacts and then you react, and the next thing you know, trade shrinks globally. That can't be good for the value of growth across the globe. So, if the trade wars get out of control, and you got to hope that they don't, that could affect the value of future growth. Now, in terms of cash flows from existing investments, Trump has talked about changing the tax code for both corporations and investors. For corporations, he's talked about lowering the corporate tax rate to 15% from the 35% that it is now. Now, I don't know whether he can get that big of a tax cut, but even if it goes to 25%, coupled with the proposal that he has to allow companies to bring back that trapped cash, this is cash that US companies have accumulated in other markets because they don't want to pay the differential tax. If the Trump proposal comes through, they will be allowed to bring that cash back on a one-time deal, pay a 10% tax rate or a negotiated tax rate, and essentially have that cash available to pay dividends, buy back stock, or invest in the U.S. But those are the tax code changes, though. Trump, President Trump can't just sign those changes. They have to go through Congress, and we know how the tax code, as it goes through Congress, gets adjusted, adapted, changed beyond all recognition. So it'll be interesting to see how that works through. We also don't quite know how corporations will react to these tax code changes. Will they bring all 2.5 trillion back to the U.S.? I don't know. Will they change the way they invest? But you could argue that the Trump tax code changes are going to show up in the cash flow. So if you pull this all together, you can see why the effect is a muddled one. Risk-free rates potentially could go up because of the higher infrastructure spending, more deficit spending, tax cuts. The risk premium may go up if you felt that President Trump would be more unpredictable than another president. The value of growth could be affected by the trade wars, and the tax effects on cash flows could potentially be significantly positive if the tax rate in fact goes to 15%. There are pluses and minuses. The effect could be a net positive, at least for the near term. And of course, the trade wars begin, it could become a net negative. But for the moment, you can see why stocks are, if not treading water, even moving upwards. Now, there are going to be some sector consequences of having a President Trump instead of a President Clinton. Let's start with the fact that Trump has promised to roll back regulations. And in his proposal, he said for every new regulation, 2 regulations have to be taken off the books. But if you step back and look at the larger scheme, if nothing else, President Trump's chosen regulators are more likely to be business friendly than a President Clinton chosen regulator. So the sectors which are most affected by regulations are probably looking towards DC and heaving a sigh of relief. That, I think, is the best explanation for why financial service firms have done so well in the 2 days, because it's not that they are expecting some help from DC. They're just looking at DC and saying maybe they won't hurt us much more than we've been hurt already. Now, if you look at the healthcare proposal and replacing Obamacare, that's not going to be that easy because the Obamacare has created roots for itself in the U.S. healthcare system. It's not clear what Trump will replace Obamacare with, but whatever there is, there are going to be changes in the way healthcare is provided in the U.S. So, for the moment, those changes look like they'll have positive implications, at least for the pharmaceutical companies, but we don't know. We'll have to wait and see how this plays out for pharmaceutical companies, insurance companies, hospitals. It's entirely possible, in fact, very likely, that there'll be winners and losers. That not all healthcare firms are going to go up, that some are going to win and some are going to lose. And we'll have to see how what the replacements are for Obamacare and how it plays out. And finally, Trump has, unusually for a Republican president, promised to spend hundreds of billions on infrastructure. Now, let's face it, the U.S. U.S. needs significant infrastructure investments. This could have positive and negative effects. The positive effect is it could provide an oomph to the economy of investing in infrastructure. The negative is if you're going to cut taxes like President Trump has promised and invest in infrastructure, you are going to create a bigger deficit, which is going to create some political friction, especially with Republicans in Congress who might feel that this is budget busting. So it'll be interesting to see what emerges out of the infrastructure component, because it could again have implications for the companies that feed off infrastructure, construction firms, engineering firms, cement companies. I mean, it could essentially have a spillover impact. So the bottom line is there are as you look through the Trump policies, you first have to recognize that they are going to have to get through some barriers to become law, at least most of them. And when they do, the effects are much more diffuse than many experts claim they will be. Now, there are lessons, though, there are lessons that you get out of the Trump, out of watching the election that I think parallel very much the lessons that you got out of watching Brexit. As I said, the first time you have something like Brexit happen, where the pollsters are wrong and something unexpected happens, you can call it an accident. The second time it happens and you see the same kind of process play out, well, maybe you got to stop and ask, maybe it's not an accident. Maybe this is something structural that's changing. So here are the four lessons that I got out of Brexit that seem to apply just as much to the Trump election. The first is the polls actually were less strong than the betting markets and the financial markets. What I mean by that is, if you look at the polls of the Clinton-Trump polls going back all the way to, September, right after the conventions, there have been periods where the polls actually closed, where Trump actually was either tied or very close to tied with Clinton. So you'd expect that at times the betting market should have reflected that. But if you look at the betting markets, there hasn't been a single point during this entire election where the probability of Trump winning has exceeded 40%. Now that's a phenomenon you saw with Brexit as well, where while the polls ran close, the betting markets seemed to not believe the polls. Now that raises an interesting question about why. After all, markets are viewed as counting machines. They're supposed to be unbiased. Why is it that there seems to have been a bias in markets that you're seeing in the prices? I think the answer is simple. I think markets are counting machines, but they're not simple counting machines, they're weighted counting machines. What I mean by that is, if you're a big bettor in a market, a big investor, you have a much bigger weight in the final price than if you're a small investor. And as with Brexit, here's what happened with the US election. The big bettors all seem to be betting on Clinton, the small bettors seem to be betting on Trump. There were far more small bettors, but they didn't have as much money as the big bettors. Democracy, though, the actual voting is not dollar weighted. A big investor, a wealthy investor, doesn't have any more weight at the ballot booth than a poor investor. So it might be reflecting a weakness of using markets as predictors in politics. The second lesson is that if Brexit was a blow to experts, this was an even bigger blow. Political experts seemed to feel that no matter what the polls said, that Clinton was going to win. And they used lots of different tools to get there. So if you look at why experts have failed on both Brexit and on the Trump election, here are some of the reasons I see that I think are things we need to think about, because this applies not just to these elections, but to financial markets and investing. The first is, I think experts have become more and more narrow and more specialized than ever before. So what you often get is experts who can't see the big picture. I think that's happening, as I said, in financial markets. It's starting to happen in politics. People have such a narrow, skewed vision of the world that they can't step back and look at the big picture. Second is, while experts have always had a mixed track record in forecasting, now their mistakes are there for everybody to see. So if you're an expert and you make a mistake, I've captured your mistake on Twitter or Facebook, or so when the truth actually comes out, I can point out the mistakes to you. And the more I can see your mistakes, the less mystique there is about being an expert. The third is, I think the mistakes experts are making have become bigger and more common as the world has become more complex. And you saw this play out in the US election. Forces that were completely unexpected, that you wouldn't have had to deal with. Now, from WikiLeaks to things happening under the surface with voting that you wouldn't have to deal with, experts had to deal with now. And those interconnections between all of those variables makes forecasting much more difficult than it used to be. And finally, if you've ever operated under the naive assumption that just because they're experts, they're not biased, I think both Brexit and the US presidential election should have brought home the truth that experts are just as biased, in fact, perhaps more so than the rest of us. I listened to Sam Wang, who's a Princeton professor of neuroscience, say that there was a 99% chance that Clinton would win. In fact, he promised to eat bugs if Trump won more than 240 electoral votes. Well, I hope he has a good taste for bugs, because Clearly, that number reflected more as bias than the numbers. There was nothing in the numbers that would lead you to believe that there was a 99% chance. But if you're really biased, it becomes very difficult, even if you're an expert, to step back from that bias. Thirdly, in keeping with the theme, and this is perhaps my self-interest speaking, this is something I have a deep stake in. I've been pushing this notion that in valuation, narrative beats numbers. That to have a good valuation, you need a story first, because people remember stories; they don't remember numbers. And I talked about this in the context of Brexit, where the people who are pushing to exit the EU had a narrative, and the people who were pushing against had all the numbers, and the narrative beat numbers. And in the US election, roughly speaking, we saw the same phenomenon play out. Trump had a narrative. You might not like his narrative. It was a narrative of a throwback to an America that used to be. We had manufacturing plants all over the Midwest producing the goods and services that we consumed as Americans. And he said, well, I'll take you back there. Now, you could argue that it's implausible, that it's not going to happen. And there were some who could even argue that the kind of story he was telling was a story for an old America, that it was perhaps sexist and racist. But whatever it was a story. Clinton seemed to have lots of in fact, I went on her website. She had hundreds and hundreds of pages of policy views, but she had no story, no overriding narrative of what she wanted to do with the country. Instead, her entire focus seemed to be that Trump by temperament, experience, and character was unsuited to be president, and that might have been enough for some people, but it's not going to win this debate. And even though she won the popular vote, so she didn't win the electoral votes. Part of the reason for it might have been that she did not have an overriding narrative. And finally, democracies, can disappoint you. I think that I'm a great believer in corporate democracy, because I think that everybody should get a chance to vote. Everybody there is, of course, shareholders vote. I would be hypocritical if I did not bring that same idea to political democracy. The voters will speak, and sometimes you're going to lose. And when you lose, you can't throw a tantrum and threaten to move to Canada. You have to, pick yourself up and get ready for the next election. And I think that I still remember what an American political consultant who was on the wrong side, the losing side, said about the voters. He said, "The people have spoken, the bastards." And I think that kind of cuts to the heart of those who feel that they've lost this election. It's what happens in democracy. Sometimes you win and sometimes you lose. And I know there will be people who say there was a lot more at stake in this election and you might be absolutely right. But I think this should actually act as a precautionary note for those people who talk about crowds and the wisdom of crowds. Crowds act in strange ways, and democracies sometimes do things that you don't like or you don't expect. And this might be one of those times. So what's the bottom line? I think when Brexit happened, people talked about how unusual it was, how it was an aberration, it was an accident. The U.S. president, it's been eerily similar in terms of how it's unfolded. The first time something happens, it's an accident. The second time it happens, it's much more difficult to argue it's accidental. I think that the fact that you've had two events like this happen in 1 year is a precursor to what you will see in the next few years, not just in elections, but in other events. I wouldn't be surprised to see the same kind of phenomenon unfold in France, the same kind of phenomenon of narrative versus numbers unfold in France next year when they have a presidential election. And I think it has implications that stretch well beyond these elections, because it goes to the heart of how we get informed as investors, as voters, and the types of leaders we have in both corporate and I think the game is changing, and we don't seem to realize it's changing. Rather than be nostalgic and beat our breasts and say this is terrible, I think we need to accept the fact that this is the world we live in, and learn to adapt and do better in this world. I hope I have not upset any of you with a very different political. In fact, I would view this webcast as a success if I asked you now whether you could guess whether I voted for Clinton or Trump, and you could not guess. I've succeeded, and I hope you cannot guess, because as I said, that was not the point of this webcast. There are others who can take much better politically charged views. This is really, as an investor, what should I do now? And the answer is right now, I'm going to be doing the same thing I was doing on November 7th, looking for good stocks to invest in, putting my money in them, and then sitting back and watching because things can change in a minute, and that's essentially what investing has become. Thank you very much for listening.